funsupermart.com.
Can you share the investment outlook on China and what investors can expect over the next 2 to 3 years?
Okay, the investment outlook for China, I think down the road the market will continue to be volatile, and the investment sentiment will continue to be a bit fragile. The reasons being, I think it's no news that the China growth is slowing down, but at the same time, it's unlikely to see the central government is having a massive easing policy. Yeah, because right now the new leadership, they are more tolerant with a slower growth. So but actually what we are going to see are more detailed measures on how to boost domestic consumption. So on the policy front, in short, we are not going to see massive easing policy, but we are going to see more and more small actions on how the government are going to boost the domestic economy. Yeah, the domestic consumption. On the corporate front, what we are seeing now is that the corporate investment willingness has been lower than the past few years. Yeah, and also we noticed that during the past few years, the credit growth is actually twice the times of the GDP growth. So it's a not efficient way of investing the capital in the overall economy. So what we are seeing now is some overcapacity in certain industries in China. But actually, this is not a bad news for some of our holdings. Yeah, because on the one hand, we have overcapacity in some industries. So this also means opportunities for some quality companies to come out to the market to be a consolidator in these industries. So good companies can take the opportunity buy the smaller ones and increase their market share. So this is actually what we are seeing on the overall trend of the Chinese companies, yeah, at this moment.
What do you think are the likely catalysts that will reignite investors' interest in China?
The catalytics, okay. I think it's the strong willingness of the new leadership to reform the overall economy. Yeah, because the new leadership is very clear about their message. They need to do effective reform for the whole economy structure, because they don't really want the economy to rely on the previous engines of the GDP, which is manufacturing and the import and export. Yeah, they want to shift the growth engine from the production to the consumption. And down the road, we are going to see if they can really take action to boost the economy, to boost the consumption, such as house care or affordable housing. Yeah, things like that. This will be cheerful news for the investors. Yeah.
In your opinion, what do you think are investors' primary concern on China, and are these concerns justified or mere market noises?
Yeah, there are some concerns on the market. Yeah, I think the key concerns is actually, as I mentioned, the credit growth has been twice the times of the GDP growth. Yeah, so which means the way of the Chinese company to invest the money is not very efficient. So there is some certain of capital misallocation in the economy. So now we have a very negative result, which is overcapacity in some industries. So it may take time for the industry to consolidate, to reshape themselves. Yeah, it's not an easy way of actually the consolidation in China. And another concern is actually the shadow banking system. Yeah, because we heard a lot of negative news on the shadow banking system in China, and the wealth management product are not transparent to the investors. And actually the regulators has also admit that they come into this shadow banking system quite late. So it has been under-regulated for a while. But now it is a valid risk, but it is manageable because the overall size of the shadow banking is not that big as people expected. And the central government is very determined to control the risk there. So what they are trying to do is they try to ask those banks to put a product from the off balance sheet to on balance sheet. So in another way, it can make this product be more transparent to the investors. Yeah.
Investors are often confused about the exposure they can get when investing in China equity funds. Can you explain the limitations of investing in China, particularly from a retail investor's point of view?
Yeah, it's actually not it's not easy for the retail investors, and actually it's not as easy to fund managers as well. Yeah, because in China it is always it is very easy to see a very fancy or decent headline news or headline numbers, but sometimes it is very difficult to translate it into real corporate earnings or corporate returns. Yeah, because we always say there's a divergence between the macro numbers and the corporate earnings. Yeah, so how to really find good opportunities in China is the stock selection, and we need to be very careful on which stock we are buying into. So, and for Aberdeen, our criteria is very high because we think what we need to invest is very good management, and the company need to have a very sustainable business model to generate constant cash flow, and and most importantly, they need to have a very strong balance sheet to weather the storm down the road. Yeah, because very interestingly, in China space, we don't really find many good opportunities. But on the other hand, in Hong Kong and Singapore, we find many good companies with experienced management, but at the same time, they have the revenue or asset exposure in China. Yeah, because this Hong Kong and Singapore management, they are very experienced management. They know what happened in the last financial crisis. So they know the importance of a strong balance sheet to the company. Whereas for the Chinese companies, during the past 10 or 20 years, there hasn't been a real credit crunch or financial crisis to test those domestic Chinese companies yet. So it is unsure whether these companies can really have a very strong risk management to deal with any major risks down the road. So for us, it is more like we invest into those good quality, transparent company in Hong Kong and Singapore, but with the business exposure to China. So it is an indirect way of investing into China, but at the same time, we find from a risk-adjusted return perspective, it is very rewarding.